Peter Rose, Longwood Currency Trading. It's a cold start of May 2022, and I'm going to take the Bo dog out for a walk before it starts to rain. I think it's going to rain. Bo, where you at, Bo? You want to go out? Oh, Bo wants to go out. A different approach to risk. That's the topic for today. Let's take the Bo dog out. Okay, Bo, let's talk about a different approach to risk. Look, I had a discussion with one of the folks I communicate with, Tony. Hi, Tony. How you doing? I hope things are going well. Been discussing some of my trading. Actually, I had a trade going that had gone against me. I picked a little bit longer time frame, and so the mechanics of all that process changed. Hey, Bo, come on, let's go. And so I had kind of commented to him on that, and I was underwater on it quite a bit, and was hoping that this week would improve itself, and things would return to normal. You get into these long-term situations, and basically what you're doing is you're changing your risk profile. I'm a day trader, and so I've got this risk profile that I'm working on, and I tend to run into trouble when I try to map that into the longer term carry trades, because I had a 40-year career in real estate, and you manage your risk just so much totally differently that it's so hard for me to be concerned about losing $6,000 or $8,000 or $10,000, or not losing it, but being underwater that much in sometimes a 6x risk to the reward. It's not that that's bad. I mean, everybody else would say that. I'm not going to walk down there because that is really wet. I'm going to stay out here. All the conventional wisdom about the stupid risk to reward ratio, and but I think what folks, which I think is stupid, and I've brought that up, as I think the reward to risk ratio is just not anything that's of any value at all. The trading metric that you're really interested in is your win-to-loss ratio. And if you have a good win-to-loss ratio, it means that in the long run, you'll be successful. Now, there's another metric that's important too, and that's your average win rate. And there's another metric called your per trade expectation value. You work those three metrics out: win-to-loss, average win rate, and per trade expectation value. Those three metrics is what you use to determine how big of a risk you could afford to withstand before you have to pull your butt cheeks together and just get out, right? You could say, oh, I'll take a 20 pip risk, or a 100 pip risk, or whatever it is you want to take, but you have to base that in constructs of what your average win rate is. I mean, you could win 8 times in a row, but if you're going to lose 5 times that amount of money, 8 or 9 times whatever you win, minus that one big flush out loss, the metrics don't make any sense to you. The other thing that you have to look at is the size of the account that you're trading. Now, you may have a 6-figure account, but you may only trade $30,000 of that. And I've said and I have a 6-figure account. I have more than a 6-figure account, but I mean a good 6-figure account. Okay, and I've long said that I trade with I'll trade 30,000 of that, 3 fulls. I might trade 6 fulls. A lot of the trading I've done recently has been 6 fulls. I've increased the size of that a little bit on this trade, so we'll see what happens, whether it's going to win out or not. But again, the problem in looking at the amount of risk that you're taking has to be balanced with your metrics. I've got good metrics, okay? In the last 4 months, I only traded 2 months. And out of those, because I had a carry trade from that I held over from the year before, 2021, and I didn't get out of that until March. So I really only traded March and April. Bo, Bo, you stay right there. You stay right there. No. Hey, come here. Yeah. He's all wound up because the mailman just comes. He doesn't like the mailman. He knows the mailman's truck. I don't know what it is. In any event, so I traded March and April. This is the 2nd of May that I'm recording this, and you guys will get this a week later. But so I've only had 2 months of trading this year so far, and of that 2 months, which there's 40 trading days in 2 months, I traded 15 days, and I'm up 24% on my risk, something like that. I don't know what it is. In the last 5 days of trading, this is what I was talking to Tony about when he said, "Well, geez, good luck next week managing this trade," and I said, it's not a matter of luck. I've been underwater an enormous amount with that trade, but I have an enormous amount of bank, and I have a large position that's pip value, adds up, and I was way underwater. So, and this was toward the end of last week. Today is Monday. And so I think I talked with Tony Thursday or Friday, and he says, good luck, next week with the trade. Well, I had hoped that it would be good luck. And so it's about 1 o'clock in the afternoon on Monday, and I've already regained $6,000 of the loss that I had. So in the last 5 days, for example, or the last 5 days that I've traded, I've made about, I don't know, $10,000. So if I would have lost and closed this trade out at my highest loss, I'd be a couple of $1,000 underwater for the month. Okay? So that's probably 3 days of trading or 5 days of trading to pick back up again. I don't know. It all depends on how big the bank is that you trade. When you take a big loss like that, you don't go back in with your full load. You limp in. You might trade with minis for a while, so your confidence isn't blown and that sort of thing. So you have to look at, it's the way that you look at risk and how you manage that risk that makes all the difference in the world as to the success or the failure. If you set, no matter where you set your stop loss, when it gets hit, you have to ask yourself, am I caught in a statistical anomaly that I'm just due for a loss? Or did I do something stupid? Maybe I should ask the Bodog what I should do as a better option than listening to myself, or as I said to Tony, the little bridge troll Ed that sits on top of my left shoulder here and whispers in my ear to do stupid shit. And, you can't help yourself. We all have that little troll that whispering crap at us. And so you have to be really, really, really careful as to how you're thinking about how big of a hit do I want to take. If you've built up a good reserve of money, say in a month's period of time, and then you see a big opportunity, man, back the truck up and load them in. Back the truck up and load it up. If it doesn't work out for you, maybe you lose a month's trading. But when it does hit, you more than make up for that loss. Or maybe it'll take you 2 or 3 of those. It might take you 8 or 10 trades to build that reserve up, and you may lose it in one trade. And then it might, because you had an opportunity where things looked really, 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 really good, the fact that you take a loss at that point doesn't mean that the trade is done. It's just that the loss went too far. That's what happened to me. There's no reason that the price should have moved the way that it moved. Jesus, when I shut the trading platform off on Friday afternoon, I just didn't want to look at it anymore. I'm working on a computer program. The spread was 14 pips. Again, another Friday with a 14 pip spread. And then boom, I shut it off. So when I got up this morning, the spread was 14 pips. Or I mean on Sunday night when the things kicked in, it was 14 pips. And then this morning I got up and it was back to the spread was like 2 pips, pip and a half, something like that. Normal. The losses were normal. It's taken all day now for that to regain that, but I'm in a manageable position now with a 1%, a little less than 1% on risk. So I mean, the loss is like a little less than 1% of the position size. So some people would say, well, you know, you take a 1% loss. You don't want to take more than a % loss on a day. Listen, boys and girls, I don't have any. I don't know. You know who tells you stuff like that? Is people that are trying to protect their money. They're not trying to make any money. You know, somebody who makes 6 figures or something from their account, and they really don't understand how they made it. They made it, but they don't really fully grasp how they made it. They get fearful, and then they do stuff to protect their account. These things like don't risk more than 1/4%. God, I see these guys. They tell you, don't risk more than 1/4 of your bank. Don't risk more than 0.5% of your bank. Why? You're going to lose 50 times in a row? Come on, really? Oh, man. When I was in real estate, you go in to buy a building, you push it all to the center of the table. You know, I didn't have a lot of money to be, you know, I didn't own 40 buildings. I owned a dozen maybe in my lifetime. Maybe a little more than that. But when you go out to buy a building, you don't have money to pay cash for it. I mean, when I retired and started closing my portfolio, this is my home, I paid cash for that. And then on top of that, another $40,000 in renovation work. It's a 1775 antique Cape, beautiful little house. And so I had cash to do that. So I did it. And I didn't have to sell my other house before I bought this one. That was my bargaining power. I don't care. You can sell me the house at what I want to buy it for, or I'll go buy another house. That's a good position to be in. So when you're looking at buying a piece of real estate, your down payment is a lot of money. I mean, if you had $200,000 for your down payment, you could buy a $700,000 or $800,000 house, $600,000 house, $1 million house. I mean, I don't know how much you'll buy for it. I don't know what the market is right now because I don't give a shit. I'm not doing real estate anymore. I'm doing currency trading. But you're taking all that money that you have and you're putting it up to buy the house. You see people constantly talking, well, it's a little bit more. I don't want to spend that much more. I don't want to spend that much for the house. The reason they can't spend that much for the house is twofold. Number one, they can't come up with a down payment that's going to be necessary to take that mortgage. And they're not really going to have the income in order to pay for it. Most folks who buy a house really can't afford the house that they're buying. And if you follow even the guidelines for mortgage approval, you shouldn't be doing that. I never did that. I just think it's crazy. And you might say, well, why do I feel that way? Well, look at what happened back in the mortgage crisis. Yes, there was a lot of excess, but there are a lot of people that were doing it the right way. You know, your income to expense ratio is this and blah, 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 and it would be this if you bought this house, and okay, you're clean and you can do that. Remember who's talking to you about stuff like this? It's real estate agents that don't know shit from Shinola. They don't buy multiple properties. They're not investors for the long part. Most of them wouldn't know anything about construction or management of real estate, but they can flip some numbers around and say, yeah, you'd qualify for this level of house. And so there are so many people that get in trouble. But I guess the point that I'm trying to make is that when you go to buy a house, you push it all to the center of the table and buy that house, yeah? And so why would it be any different if you're doing currency trading or trading old tires or cars, or what difference does it make? You're not going in to lose it. You don't put $100,000 down on a $400,000 or $500,000 house to lose it, to have the value of the house go down. The value of the house may go down. And in fact, if the value of the house goes down below the value of the mortgage, the bank is going to call you up and tell you to make it good, or they're going to slam the door on you, right? So that's the risk that you take. You're assuming that risk. And most of the time, if you talk to somebody who knows what they're doing in real estate, they'll show you how to structure the deal and whether the deal makes sense for you in your particular situation. And they'll look at the worst case scenario. Yeah, you got a good job today. What happens if they put you on leave? What happens if they shut the door? What happens if they come across and say everybody's going to take a 12% pay cut? What's that going to do to your disposable income for things like, heating and stuff? I just paid $800 for my last oil delivery bill. And geez, last year I was paying about $280 to $325 every couple of weeks or every other week. I get one bill for $800 this year. Price of oil has gone crazy. But that's risk. That's looking at your risk. And so when you're in the currency trading arena and you're listening to these people talking about trading, why don't you ask yourself, what the hell do you really know about what you're talking about? Are you talking about risk to reward ratio? Shut up and sit down. You don't know what you're talking about. Are you talking about taking a 1/4% or a 0.5% risk? Shut up and sit down. You don't know what you're talking about. That's not how you made your money. You didn't make your money by taking a 1/4% risk, because if all you took was a 1/4% risk, you'd never grow the account. You know why they're afraid to take more than a 1/4% risk? Because they have a $200,000 or $300,000 or $400,000 account size. They worked their way up and just jammed it. They found some really good volatile times. Maybe they were foolish enough to have done that on 200 to 1 leverage, and they got lucky. Listen, anybody that's trading on more than 50 to 1 leverage is crazy. If you're trading on more than 50 to 1 leverage, let me give you some free advice that would otherwise cost you a ton of money to get it from me. Get out of the currency market. You don't belong there. If you're trading at 100 or 200 to 1 leverage, you're crazy. You don't understand money management, let alone risk management. Holy Christ. You better find yourself somebody who understands this stuff and that will sit down and teach you, and you pay them any amount that you want. Because let me tell you something, when I started learning this stuff back in 2007, and then I didn't get really into the trading until 2012, opening a mini account and then a big account, and I think it was 2018, 19, something like that. It cost me $40,000 because I thought all these people knew what they were talking about. They don't. That doesn't mean they didn't make a lot of money. It doesn't mean that they don't know how to trade, but they damn sure don't know what's important, and they don't know how to teach it. In the coursework that I have, I don't even mention staging or compounding. That's for the advanced course. I have 400 pages written over 3 books and a 4th workbook that goes through the principles of trading. Not when the short moving average crosses the long, or the fucking bat pattern says this, or the Fibonacci spiral of death pattern is telling you that you ought to sell. It's aggravating for me. It's aggravating for me to listen to this shit, because it doesn't mean anything. It really doesn't. And so when you figure it out and you do it right, then you're like me. In the 2 months that I've traded, as I said, this year, all I has traded was 2 months, March and April. I had trades that were opened and closed 15 days. Okay, in other words, I traded 15 days. And I have not had a losing day in 2 months this year. Now, one day I had a $12 gain. Another day I had a $2,900 gain. So, but I didn't have a loss for the day. And I mean, I think the smallest gain other than the $12 gain was, I don't know, I had a couple of $125 days, but most of them were $300-400 days, $600 days. So that's consistency. Now, I don't call the equity curve that I have consistent on a trade basis, and even on a daily basis, because it goes way up with the win, and then it goes when I lose. It's a big loss. So I'm not a real true believer in looking at somebody's equity curve that goes, it just goes like that, but the daily fluctuations could be, the range of them could be quite substantial. A really valid equity curve is, for example, over the last 6 months, on a daily basis, if you're tracking the equity curve on a daily basis, the range, like an ATR, has been $400. So you don't make over 400 and you don't lose over 400. If you have an equity curve where you lose $800 one time and then you make $1,000 the next, and most of the rest of them are within that 400 band, and then there's another one that dropped 700, and then you go, that's not I don't care whether you've got a rising equity curve or not. That's not the kind of equity curve that you would base your trading on. There are other metrics that are more meaningful for you when you have that sort of trading. The smooth equity curve that is necessary for consistently growing a large account is within that narrow band. But when you're getting started to get to the point where you have a large account, you're going to have days where you're swinging for the fence and you hit it out of the park, or it just ground balls out and you trip over the ball as you're running toward the base. It's just crazy for you to think in any other way about risk management, particularly in the early stages of either your experience or your bank. And so when I start somebody out, I start them out on a one mini account. That's it. If you can't trade successfully a one mini account and have a decent equity curve, none of this friggin', I traded a buck a point and I made 55 pips today, and then 3 weeks later I lost 28 pips. That doesn't make any sense. So you got to learn good trading habits on a daily basis so that you build some good metrics and that you have confidence in your equity curve, which you begin to understand differently regardless of whether it's a jagged tooth one or whether it's a smooth rising straight line with very little range differential in it. Well, every now and then you're going to take a bad hit. You're going to hit 6 losses in a row. You just can't, you can't help that. If you're trading with any frequency at all, even if you're a good trader, you're going to hit those 6 losses in a row. and that's on a transactional basis, not on a day basis. You're not going to lose 6 days in a row. You might if you do 2 transactions a day and you do 6 of them. You lose 6 transactions in a row. You're over 3 days of trading, right? But you're basing. See, some metrics are based on a transaction level or a position level. So I might take 3 positions a day, and then I develop my metrics from the positions, not the day. It really is immaterial whether you're a winner for the day or not. It's based on the positions. Your metrics are based on the positions. I don't have a win-to-loss ratio that's based on 6 winning days for every 4 losing days. It just doesn't make any sense. You're clouding the issue. So to be careful, you have to understand probability and statistics well enough. You don't have to be a mathematician, but you have to understand how to use the data that you have to provide you metric information that will allow you to judge the type of risk that you can take at any given time. Again, to summarize, based on your account size, your personality, that comes into play, what the chart is offering you, your volatility, your win-to-loss ratio, your average win rate, and your per-trade expectation value. Those are all 3 metrics that will guide you in looking at risk differently, okay? Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day. I'm going to collect up the Bo Dog. I don't know where he is. There he is. Hey, Bo, let's go inside. We'll go inside? All right. We're going in.